Last week, we revealed the 3 keys to a successful high cash value life insurance policy. This week, we're talking target premium. What does it mean? It's important. Stick around. This is the Life Insurance Financial Education Podcast where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with NetWealth Finance.
All right, Carlo, target premium. I say that it's a misnomer to my clients all the time because when you think of a target, you think that that's something that you should aim for. But for most policies, I think we can just ignore target premium in regards to what we should try to fund a policy as and treat it more as how it's going to affect the expenses in the overall policy. What do you think?
Well, I think that's definitely the way that we tend to look at it for how we look at life insurance and this vehicle for cash growth. Target premium is the primary measure with which the insurance company can determine how much expense they're going to have to recoup. And a big part of that is the agent commission. So the goal is to have the smallest target premium possible to maximize that cash growth.
Yeah, well, that's an especially designed policy for us, right? But target premiums vary wildly among carriers and the product design. We specifically design policies that reduce target premium as low as possible in order to fund way above target premium. But in a bad design policy, can you fund it at target premium and assume that the policy is going to be okay?
Yeah, that's effectually what the insurance companies that's their public facing explanation as to what target premium is. It is, in a sense, what you could fund a policy at and reasonably expect under normal market conditions that policy should not lapse if you fund at that target premium. But that is not guaranteed. So keep that in mind with an IUL.
Now let's specify too, that target premium is determined on the base amount of life insurance. With the blended designs that we like to do in order to max fund a policy and turn into massive cash value, that target is very, very low because we put the base amount of insurance very low. And all that supplemental term that we're blending in doesn't pay anybody a commission, so it doesn't increase the target premium. So if you had an optimized design policy like we designed, what happens if you fund it at target premium?
Well, if you don't drop off that supplemental term, it is most certainly going to lapse as you get into older age because that supplemental term, where you might have 10x'd your base premium with that supplemental term, that really becomes expensive in old age. And if that funding level for that target premium, because we've minimized it, it's so much lower than that cost of insurance will be in old age. And it'll definitely lapse if you're funding at that minimum.
Yeah, and target premium, even in a policy that has a very high target premium, whether it's an optimized design with a lot of death benefit or a non-optimized design that just carries a large target premium because it's paying out a big commission, the target premium is usually only a little bit higher than whatever the minimum is that's required to keep a no-lapse guarantee in place for a certain number of years. But those no-lapse guarantees are typically only 10 or 15 years. After that, you're relying on the actual cash growth in the policy to cover the expenses. And if the expenses are based on anything other than the base of that policy, you might have a hard time keeping up with it.
And that's where we really stress on this podcast that whatever the minimum or target or these other things, that's really not what you should target as the client. You should target max funding. Whatever that MEC limit is, that is what you should target funding at. And if you fall short because of our optimized designs, you can fall short of that a little bit and still be just fine. Have years where you miss making that max fund, maybe catch up the next year. That flexibility is there, but ideally you're funding significantly higher than target so you have a safe amount of cash in there and your cash value will grow faster. That's how you get that optimized cash growth in these IUL policies.
Yeah, let's make sure that we're clear that we've been discussing target premium in relation to IULs, but target premium can also be present in variable universal life, and we're starting to see it in whole life as well. I used to only see it in one product in whole life, but now other carriers are starting to list target premium. My thinking is that's because they're shifting compensation to match what target is designed for. And there's all kinds of different designs and there's different products. And target is one easy way for them to kind of track commissions across a bunch of different product levels because they can just refer to that one number. So it kind of makes it easier on the agent side to see that target number. But from the client side, target premium doesn't effectively mean anything on a whole life policy.
Yeah, in a whole life policy, you have your ability to fund at that premium amount, and you should have that death benefit when you die because it will be paid up. And so, yeah, it does seem like it's just something for probably standardizing for agents to understand, and for managerial purposes, maybe back of house stuff that might be helpful for especially carriers that have some IULs and whole life as well.
Yeah, well, in a whole life policy, you just have to fund the base amount of that whole life every year, and that policy will not lapse. You might lose the ability to contribute paid up additions. You might lose some of the term insurance that you may or may not have tied with it, but target isn't going to play into what you're funding it at in the case of whole life. So it's interesting that we see that term pop up now in a lot of whole life policies where it didn't before.
Yeah, and I think that's when we're thinking about IUL, a lot of this stuff has become popular. I think it is growing in popularity, and maybe that's where some of that language and terms has also made its way back to whole life. Even though, like you said, it really doesn't mean anything because if you pay that base premium for a whole life policy, you will have a guarantee of having that death benefit for that base whole life, and that's just the way it works in whole life.
Okay, so let's shift back to IUL. And would we recommend funding a policy at target premium?
I think no. The generally speaking, our goal should be to go significantly higher than target. You don't. Not everybody has to go for max funding because there is a possibility where you might have income growth that you have planned in your head, but it doesn't work out. But you still want to possibly grow it a few years later. So if you're having some space in there, that's fine, but getting as close to max funding is really what you should be thinking about with really any of these cash value life insurance products.
Yeah, we kind of covered this in an earlier episode where we talked about minimum funding, overfunding, and max funding as the three different options for how to fund a policy. Well, target premium is kind of like minimally overfunding a policy. We're not funding it by very much more than we possibly could. Now, in a bad design policy, when I say bad design, I mean we don't do any type of a blend to reduce the target premium to reduce that commission. It might not be a bad design if you're only getting $100,000 death benefit and there's no ability to do a blend. Okay, so assume we're talking about higher levels of death benefit. But in a bad design policy that has no blend, the maximum funding might only be a little bit higher than target premium also. There might not be that much, but you want to give those policies every chance to succeed. So you always want to max fund in any year that you can with an IUL.
Yeah, it is important that you get as much cash in there as early as possible so you can get that time to build up cash value before that life insurance gets expensive. And if you do that, then you'll be pretty solid. You can have a lot of flexibility once you've funded heavily in those early years. So you have that ability to fund at lower levels or whatever it is. But ideally, whatever you can or whenever you can, max funding should be the goal for everyone. And I really like what you said earlier about target is that sort of low level overfunding. That's what it is. It's like maybe 10% higher than what would be the minimum. It's not exact numbers, but something like that. is what that is. And really, we're looking to go significantly higher than that. Multiples of the minimum payment is what we want to do when we're max funding.
Yeah, and an optimized design like we espouse, if you max fund that in the first year, you probably just paid 10 times the target premium, which means you just met the minimum premium for the next 10 years. And that builds in all kinds of flexibility in the future where you can go years without making any payments because there's more than enough cash in there to cover the expenses and to meet any type of minimum no lapse guarantee.
And in an IUL, when you do that for a few years, you max fund for a few years and you got, you 10x that minimum payment, you also have a lot of opportunity to get some of that cash growth that comes along with it. And even if you need to take a loan against it or whatever it might be, there's a lot of stuff that you have opportunity to have for growth in that IUL when you max fund it early.
Yeah, and of course, funding it at the maximum level and all the benefits that go along with that work in all of the other life insurance products as well. Next week, we're going to talk about TEFRA and DEFRA. What do you need to know about TEFRA and DEFRA? Stay tuned. Appreciate you joining us for this week. I'm James Barber, your Oregon Cash Flow Pro. I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. See you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.